Hello, everyone. Welcome to our roundtable. Today, we're going to be talking about current market conditions and some of the things that could impact your portfolio that you might want to be aware of. Today, I have with me our lead case design, James Egstrom, our portfolio analyst, Chris Krug, and our lead advisor, Crystal Ackley. Let's get started. A lot of things are going on in the marketplace, and many people are concerned. And you see a bunch of news, economic, some are good, some are not so good. There's inflation, there is a number of things. So we want to address some of those things and their impact on our clients' portfolios and how the confidence wealth philosophy that we built has impacted those portfolios and how many of our clients should be thinking about what's going on right now. Let's start with you, Crystal. Could you tell us a little bit about your thoughts on the subject?
Sure. So obviously there has been lots of headlines per se, right? And talking heads, this is usually when the time comes and we're going to hear a lot of things. And this is where you actually need to really step back and evaluate and make sure that do I have a good plan in place? And if I have a good plan in place that's already been tested and we ran all the stress testing on it, and we knew putting it in place that there will be some volatile times ahead. And if you are a holistic client of ours, then you know that this has already been tested. Your portfolio is supposed to stay in the same comfort zone that we all were comfortable with, you were comfortable with, and that there is no reason to jump ship, because this is usually what happens. You also have to be very careful about what's coming and what you're reading, because there's a lot of times agendas behind a lot of those articles that you read and what they want you to do and what they want you to purchase. So you have to really set the emotion out of it and remember again, did you have a good plan in place? Did you agree with the risk that we took at the time? And is your Monte Carlo simulations and all the scenarios we're running is still coming back successful? So I know James and I have been dealing with a lot of that Rem lately, just looking at rerunning numbers, looking at our clients' portfolios, their specific unique situation, and just making sure everyone is on the right track. And that's why we wanted to be really in front of you today. So you understand and, think of reason when you're, reading these things and don't get emotional over it.
I think what we go after here, and to be clear about that, it is a top-down approach at Confidence Wealth. Ultimately, we want to hedge your risk. And I think in every single case we take in here, we make sure that the risk is lower to a point where we can mitigate some of the market conditions. No one can mitigate everything in the world, but there are definitely ways to make this a lot better. Chris, can you talk about some of the things that are out there in the marketplace that is out of concern to people? And maybe, James, you can talk about some of the things that we have done or we do to mitigate those.
Yeah, absolutely. Thanks, Rem. So there's really three different factors we're looking at this year. Number one is inflation. Obviously, everyone's been reading the inflation numbers lately. Number two is the potential impact of what the Fed might do this year as far as are they going to raise interest rates 2, 3, 4 times? They're going to stop buying bonds out in the market. And then the stock market broadly, what is the stock market doing? Is the market up 20%? Is it down 20%? Obviously, that has a big impact on our portfolios. The challenge we have is if we start to try to change the portfolio significantly to try to account for some of the things that are happening, we risk deviating from our plan. And if we're wrong, we're going to pay the price. The other issue is that these three factors are all interconnected. So inflation impacts what the Fed does. If the Fed raises rates, that impacts equity markets. The inflation's impacting equity markets. So all these interconnected factors make it a lot harder to think about how we're going to change the portfolio to account for just one of those things. Like we can't just be worried about inflation, for instance. We have to take those other factors into account as well.
Thank you, Chris. Those are great topics and certainly the things that are on the top of our mind. And rising interest rate, inflation, certainly the big headline that I feel like I've heard the most about recently. And I know we've put some thoughts out there with some inflation hedge items, but I have to echo Crystal and what she said is that we put these plans together knowing that inflation will go up and down. We're going to go through market corrections, whether that's caused by COVID or a housing bubble or a .com bubble who knows what the next one will be, right? We just don't know. So that's why we put these plans in place to stress test them ahead of time, knowing that we're going to go through these different market events. And as we go through this, we're going to stress test it even further. So for instance, in some of our plans, we're increasing the inflation metrics to see how does the current plan withstand a higher inflation metric. The Monte Carlo that many of you have seen us run with you is already taking into account some randomized inflation throughout all the years that it's running in there. So we're definitely accounting for these things well ahead of time to make sure that no matter what types of events come, we're comfortable with the risk of our portfolio. And we know that we have a high probability of success of getting from point A to point B. Right. That's why we set goals. That's why we go through risk questionnaires and understand your circumstances as best that we can so that we don't necessarily have to worry when the headline comes up, says you need to sell everything and move to cash, or buy gold, or everything into Bitcoin. Right. Those are the headlines that we hear. And I can't tell you how many emails from different advisors out there, clients, prospects of various, newsletters or headlines that we hear where, it's almost the fear mongering where they're trying to create that sense of fear in you, but you really should focus on that plan, looking at what are the upside downside risks. Am I comfortable with that? And am I really on track to achieve the goals that I've set forth? How much income do I need in retirement? Do I need to buy a new home? Am I leaving so much to my kids and getting that estate plan in place? These are the things that are all planned for ahead of time. So that's where we come back to the plan. Do we need to make some minor adjustments? If we have new assets coming in, we might add some inflation adjustments in there, right? Some real estates are nice things. Commodities are already part of a lot of our portfolios, so we're planning ahead on those things. So again, I'm the brokered record on these roundtables because I always say to stick to the plan, but that's really what it's all about. We're going to have all of this noise coming in. If we can drown out that noise and really focus on our own circumstances and the plans that we've put together, we can hopefully avoid the stress that comes with all of the headlines that we hear out there.
And let me add something to James's your point, in a sense, that the news, it's not just bad news, it's good news as well. So good or bad, it really is the same. It's being in a place where you're in the middle, where you're not being affected by all the good news or the bad news. Lots of times you see people getting excited. Oh, it's good news. Market is up. As you said, James, gold is up. This is up. Okay, well, these are all lots of times temporary. And at some point, if you just hold steady, you're going to be able to capture the gains and the good things out of these things. But at the end of the day, the other way is also matters. When things turn, you're going to also be in a good place. So the idea behind it is that whenever you're reactionary, whenever you go after something that is shiny, we always say the shiny object for the time being is when it ends up being a problem. The shiny object when it's good, and then the fear when it's going down. The plans we create are constantly being monitored and tweaked for the betterment of the client situation. So I think that's that balance that it provides is really what we hope would keep the client in the right place and keep them in good standing with their plan.
And Rem, I agree with you. One of the things that's really important is if you're listening to this, we keep saying if you have the solid and right plan in place, because that is the key. If you don't, and if let's say you're a friend of a client and you're listening to this, or maybe you're met with one of our advisors, but you haven't yet finished your planning sessions or so forth, that's different. Then I can definitely understand you would be a little bit afraid. You will be a little bit more fearful because you don't know, it's that unknown. But when you do have a good plan in place, that's the whole point about you don't time the market. It's your time in the market the right way. There has not been, if you look at, if there was someone or these talking heads, right, or these headlines, they knew exactly when to pull the trigger, when to get out and when to get in. First of all, we would probably most likely never hear about them because it would be a secret and they would not want anyone to know, or it would be out there and the price would be so high that you couldn't even afford to actually have that plan in place because it doesn't exist. And Chris, maybe you can talk a little bit about that because you read about these talking heads that do talk about get in and out and why when this happens, this is what you should do when this happens. And what has been your experience knowing and looking at these charts day after day of what happens in the market.
Crystal, that's a great point. And there's really two aspects to timing the market. Sometimes it feels like, well, the market is trending down, I should get out. But the flip side is also true. You have to know when to get back in. And, the average person watching the news, it's kind of easy to feel like things are going bad. The market's down 15%, 20%. Maybe I should get out. Now, if you get out and you're in cash, you have to figure out when to get back in. So I actually went through and looked at 2020 when COVID first brought markets to a bit of a halt. If we assume on February 19th, you have $100,000, right? 8 days later, the market's down 12%. You've lost $12,000 in just a single week. And that's how fast it happened, right? So the market's down 10% before you've even started to think about making a change. You start thinking about getting out. You don't have a backup plan because you have a well thought out plan. So we don't have a backup plan because we're not planning to get out of the market. A few days later, it's back up a couple percentage. Another week, now you're down $73,000. So you've lost $27,000 already. Now you panic and you get out and you move to cash, you move to gold. Again, you don't have a backup plan, so you just panic and you move to cash, right? Now what do, right? 2 weeks later, you would have lost another $7,000. You're feeling pretty good about it, right? You're like, I made the right decision. Just 3 days later, the market's rebounded 17%. You now would have been back up to 78,000 when you got out at 73,000, right? But you've locked in $27,000 of losses. Now you're trying to figure out, what do I do? Do I get back in? And the market's volatile at this point. Some days it's up 3, some days it's down 3. So finally, the market stabilizes a few days later, you get back in. Typically, you would wait even longer than that, but I'll give you the benefit of the doubt. You got back in at a decent level. Now you end the year at $98,000.